this is Keith Schneider, CEO of MarketGauge.com, and this is April 1st, 2018 edition of Market Outlook. So let's take a look at the markets, and after a very, very volatile, choppy couple of weeks, see where that's left us at the end of the first quarter. So the first thing to note is that all of the key indices are wedged between two critical moving averages, right? So the first thing, right, looking at the S&P here, you can see that there's the 10-day moving average, here's the 50-day, the 200-day. So you're wedged between that 10 and 200-day moving average and looking for direction on the S&P. Now, let's take a look at NASDAQ. Same scenario, under the 10, above the 200. The big difference here, of course, is that the 200-day is quite a bit stronger distance away. So there's definitely more pressure on the S&P 500. Now, taking a look at the Dow, similar story, right? You basically touched the 10-day, bounced nicely off of that last severe decline in late March, and bounced off of that and are a little bit further distance away from the 200-day moving average. Now, what's interesting is what really had been lagging the IWM, the Russell 2000, based on the recent decline in February and the last decline in March. This is showing the best relative strength based on a momentum basis. So you can see here, momentum in February touched down at the 200. Right now, we're holding above it. So that's an improvement from the Dow, and it's also quite a bit stronger than the S&P 500, which is the weakest in terms of momentum. So as you can see, momentum got down here in February, and in late March here, it's a bit weaker. So a lot more pressure on the S&P 500 than the other indices. Now let's take a look at the weekly charts, because that's showing a slightly different picture. In fact, on a longer term basis, right, we can see that, look, the Dow, right, relative to the other indices are doing a bit better. In fact, it's holding onto its 200 week of real motion in a much stronger way than the S&P. So you can see here, S&P already breaking down. And on a weekly chart basis, it's actually violated the low from February. Not the case in the Qs, where it just matched, or the IWM, where you can see the last decline held at a higher level. So what you can see is a shifting here in momentum. Momentum precedes price. So we're looking for really the IWM to pick up the bullish tone here, if that does in fact happen, where we're bouncing off of these sort of critical levels. But interesting to note, it looks like you're getting an important breakdown in the S&P in terms of momentum. Now, that does not mean the market can't bounce, but the other thing to note, and let's just take a look at the daily charts, because this is an important shift as well. Look, the 50-day moving average slope has turned negative. So right now, right, there's the 50-day, that's the blue line here, that's the moving average, and that is sloping down. Now, in terms of looking at the Dow, you got the same scenario, downward slope. IWM, not quite as pronounced. So again, that's consistent with our overall momentum reading. And the NASDAQ, relatively flat, even with this nasty action to the downside based on, the big tech stocks. So the best thing you can say here is that we're hanging on pretty much to the longer term moving averages, the 200-day on the daily charts, but there definitely is erosion. So let's see what happens. I wouldn't be surprised to see the rally maybe take out the 50-day, suck people back in if there's a rally, and potentially roll over. So that's the thing that we're looking at. And of course, what we mentioned before is on the weekly charts, slightly different picture where the Dow is definitely looking the strongest, and you're getting that breakdown here in the S&P. So the fact of the matter here is you got lower momentum readings on this last decline, even though the last decline was higher in terms of absolute price. So another test, possibly a violation of the 200-day moving average, and looking for some support on that 50-week, which pretty closely coincides with the daily 200-day moving average as well. All right, let's move on to the next area. So the next thing to note is one of the key intermarket relationships we like to examine of risk on versus risk off is looking at the S&P versus utilities. Now, you can see over here we had an important breakdown in the S&P versus utilities in early or to mid-March period, and it has been progressively getting worse. Now, the other thing to note is you had sort of a similar scenario occur where the S&P was weakening against utilities. But this was a completely different setup. Why? Notice when this occurred in this area down here that the market for the S&P was in a bullish phase well above the 50-day and the 200-day moving average. The same thing can be said for utilities. So utilities, they were both in bullish phases, and utilities were acting stronger. That's a completely different scenario than what you have happening right now, which is true risk-off concerns, because you can see utilities, right, are above the 50-day moving average, but in a recovery phase, right? That's a lot different than being in this area in here where everything is in gear. Now, the other thing that's happening, which we noted, is we're under the 50-day moving average, hanging on to the 200. So that puts us into a strong warning phase because the 50-day slope is eroding, right? Negative slope. So the market is not the same that it was back in the beginning of the winter or late fall, right? Different scenario than several or 6 months ago or so. And that is important to take note, that looking at where the markets are, these two key markets here, the XLU, utilities, and the SPY, understanding the fact that they were both in bullish phases. Different story now with the S&P under pressure means that the markets are definitely showing some signs of stress. So it'll be interesting if we find some support here, which would coincide with a bounce off of this 200-day moving average. One thing to note more on the positive side is looking at gold versus the S&P, and also gold versus wood. So sort of what is the overall inflationary picture? And right now, if you take a look at wood versus gold, wood, right, which is representative of commodities, definitely outperforming gold, right? This ratio here, or this intermarket relationship, right, you can see here's the 6-month moving average of the ratio. This is the 1 month, the black line, and wood is outperforming gold, which is telling you that there's some inflationary pressures on the market. Now, alternatively, what we like to do in terms of looking at the S&P versus gold as a anxiety index or a inflationary type scenario. This relationship works in two ways. One, it's looking at basically the fear index, right? Alternative assets to the S&P when gold is outperforming, but sometimes gold outperforms the S&P when there's inflationary pressures and everything is going up. So you've got sort of a mixed message because on the inflationary indicator, wood outperforming gold, and at this point, the S&P underperforming gold. So you can say that there's probably more of a concern about inflation and economic scenario as opposed to geopolitical concerns. Okay, so now the other thing to note is on our volume analysis, institutional volume is showing real signs of distribution. In fact, this is some of the weakest that we've seen in quite some time. So if you take a look, let's focus on this right in here. As you can see, on Friday, even with that nice bit of a bounce where the markets were up on average over 1%, volume was still light and less than the prior days and less than the average volume. So what you've got now is over the last 2 weeks, 0 accumulation days in the Dow Jones, the S&P 500, and the NASDAQ 100. Remember, we had mentioned earlier that it looks like that the Russell was definitely looking a bit stronger last week, and that still is the case. So IWM holding up better, that's in a neutral zone. The rest of these are really showing lots of pressure as we have no positive accumulation days. And of course, as you can see, the shortened week, we were actually down pretty decently for the last 4 or 5 days. So there you have it, added pressure, right? We're looking at the overall momentum. It definitely looks like it's starting to roll over. Volume is certainly confirming that there seems to be some distribution underway. Now, let's take a look at sectors and see what they're showing as well. So interesting to note here is if you take a look at this, that we now, over the last 3 months, right, most of our sectors are down. So not a good sign. And more importantly, recently, right, with the market under the 50-day moving average, you've got a scenario where every sector in the market is either in a warning phase or worse, right? So whenever the market trades under the 50-day moving average, while it's still the 50 is above the 200, but the price is under the 50, that puts you into a minimum of a warning phase. So what's interesting, no sectors are in bullish phases. That is definitely something that we have not seen for quite some time as well. And that's just telling you that there's pressure across the board. And one really simple way to look at it is this particular chart here. So you can see down in here, right, while the market was sort of, heading sideways, and there were some pretty interesting declines, you can see we've got over here the number of sectors up versus down, and there you've got a nice jump here. You can see you definitely got some deterioration in the way the sectors are acting as well. So with the market hanging on for dear life at the 200, it'll be interesting to see. And again, the key thing to watch is that 10-day moving average. And again, this is the weakest index. Now, I wouldn't be surprised to see a pop maybe getting up to our declining 50 or taking it out, getting people convinced that everything is okay again, and then potentially rolling over. So the key thing to note is, of course, you've got this declining 50-day moving average. Okay, now moving on to market hotspots, there are a couple things to note as well. That some commodities, in line of what we're mentioning before about wood, but we also got a really nice move in corn. The other thing to note is, right, oil and gas, XOP actually did well. Metals and metal mining actually held up okay over the last 5 days of trading as well. And some third world or emerging markets actually also did better than the established markets, and especially the US. So again, inflation, inflationary pressures, and emerging markets, definitely keep an eye on those two different asset classes. And those are the big themes that we can ascertain from the market hotspots page. All right, so that's it for now. And again, the big summary here is that there's some definite long-term chinks in the bullish armor. It doesn't mean that the game is over. We're holding the key 200-day moving averages, but you can see the underpinnings are starting to weaken, especially with the downward slope, the lack of participation, or any of the particular sectors doing better or even performing well over the last couple of weeks. So there's definite deterioration and some pressure. It'll be interesting to see what the markets do directly from here. All right, have a great weekend. It's a long one and a nice holiday. Thanks, and see you next week.